So you're kind of handcuffed and you have to keep the tenant in there. It's somewhat similar to New York in some areas of New York.
August Biniaz didn't come from Wall Street. He came from Canada with a vision, a gap in the market, and the willingness to figure it out. In this episode, we sit down with the co-founder of CPI Capital on building a cross-border real estate syndication business, from raising the first dollar to closing independent deals and expanding into build-to-rent. Real talk on imposter syndrome, investor education, and what fulfillment actually means when you're building something from nothing. As always, if you found value from this content, please like and subscribe. All right, August Biniaz, welcome to Beyond Fulfillment.
Thanks for having me.
Yes, thank you for being here. So August, you are a very successful entrepreneur in the real estate space, and you've been in that industry the past 15 years or so. You actually got your start in Canada, and your start looked a lot different from where you ended up, and you've got quite an interesting entrepreneurial journey. So if you could, just to set the stage for our listeners, can you talk about how you became an entrepreneur and give us your backstory?
I think really being an entrepreneur is something that you have in your heart. Some people are just driven and they just enjoy what entrepreneurship really brings with it. And I think I always had that spirit from a young age. The journey into real estate and for real estate to be the catalyst for me to pursue my entrepreneurial journey was as a result of my mother was somewhat of a real estate investor. She was investing in real estate, dabbled in it. But my maternal grandfather, he was a real estate broker. So I come from somewhat of a real estate family. So it just made sense for me to pursue real estate entrepreneurship. And I got my real estate license in my early 20s. Soon realized that wasn't the industry I wanted to be in as far as being in the brokerage side. But I really enjoyed the sale, particularly on the value add side where you could buy something, fix and flip it. So I started doing that, doing small fix and flips, and it was very profitable. Soon after, I started my own general contracting company and started building actually homes from the ground up. So ground up development, single family homes, both spec and custom. So in the single family development space, spec home is when you build a home either with your own funds or you raise some money from investors and you build a home and you put it on the market and you sell it and you share those profits with your partners or keep it for yourself. And custom home is when somebody hires you to build them a house for their specification. So I did both of that for close to a decade. Again, the entrepreneurial spirit kicked in and I always wanted to scale, do bigger projects. And Vancouver, where I'm originally from, west coast of Canada, had gone through a real estate boom. Real estate prices, in the 2000s, the first, 15, up to from year 2000 to 2015 or so, real estate prices had gone up 500%. So both in Vancouver and Toronto, there was a huge immigration population that had come to Vancouver, mostly from China, from Asia, and Asia had become super wealthy. And I call them really the dollar store of the world. First thing they would do, they would come to Vancouver and they would buy a home there. So the real estate markets had gone on a bull run in that 15, 20 years. Definitely rode that wave. But I always wanted to do bigger projects, always wanted to scale. I saw the growth of also high rises and skyscrapers going up in Vancouver, and I always wondered how those deals are structured. You usually see a brand on a building, but that brand doesn't even go to who the partners are, how is the capital stack put together, who's funding the deal. Usually you just see a brand like Ritz-Carlton, but Ritz-Carlton is just putting up their name. It's the actual developer and their capital partners that are coming in and funding the project and managing the project. So realized that early on, and I was wondering how can I get to that stage. And when I looked around my space and who were the people building these mega projects, it was always usually multi-generational. It was never somebody who, woke up one day and was building high rises. It took a few generations. Vancouver is a very multicultural city. So, I wanted to expedite that process. I wanted to get there without, my grandkids being the ones building high rises. So started researching how deals are structured. Soon found out about this term called syndication, where people can go to the members of the public and raise capital through a fund model or project-specific model and so on. But most of the information I was learning and I was gaining was coming from the U.S. There wasn't a lot of platforms in Canada which allowed which created a lot of content about capital raising, syndications, and funds. Most of that information was coming from U.S. platforms. And another thing I realized is this new business model that wasn't really possible in Canada, which was multifamily value add. And to define what multifamily value add is, basically apartment communities, mainly in the Sun Belt, they're garden style, and groups would buy somewhat older apartment communities built in the 70s, 80s, 90s. They would do some small renovation. They wouldn't even go down to the studs. They would just upgrade the countertops, change the lighting fixtures, plumbing fixtures, change the flooring, put paint on, and do some upgrades to the exterior. And they were able to force appreciate the property value, and in a very short period of time, 3 to 5 years, and they were able to get great returns for their investors. So I really fell in love with that model. And when I looked around Canada, I felt that by bringing these U.S. multifamily deals to Canadian investors, myself and my firm would have a competitive advantage because, number one, the multifamily value add model doesn't work in Canada because the yields are much lower in Canada, the cap rates are higher, and the fact that regulation doesn't allow for the value add model, because the value add model is where you go in, you buy a property, let's say 100-unit property is currently sitting, let's say, at 90% occupancy. So the 10 empty units, you go and renovate those units, bring them online, and rent them for a higher premium than your classic units that you have. And as leases expire for your other 90 units, you don't renew those leases. You just, again, do the renovation, bring them back up to higher standards, and bring up the rents to market rents on those units. This wasn't possible in Canada, because in Canada, when the tenant rents an apartment from you, you cannot terminate the lease as a result of upgrades or renovations. So you're kind of handcuffed, and you have to keep the tenant in there. It's somewhat similar to New York in some areas of New York.
If your business is an e-commerce brand, this message is for you. Logistics can make or break you. If you're tired of being just a number to those big box 3PLs, you need to check out our team at Easy DC 3PL. We're a different kind of partner, built specifically for growing brands that ship between 1,000 and 10,000 orders per month. We offer warehousing, fulfillment, and transportation with a focus on personalized service and flexibility. Our central Kentucky location gives you nationwide reach, turning logistics into a competitive advantage. So if you're ready to partner with a 3PL that actually gets your brand, visit easydc3pl.com.
So realizing that, a few years back, co-founded CPI Capital with a couple of great partners, and we went on this journey of being able to bring in U.S. deals to Canadian investors. But I'll stop there, because I think the hard work really starts after all of this.
Okay. Yeah, no, I appreciate the backstory. So you had this kind of family history in real estate. You got into it early 20s. You realize you don't want to be a broker. You start doing the fix and flips. You start your building company. You realize some early success. You really learn the industry itself, and you're becoming an expert. And then you're naturally curious, because you really love this industry, and then you want to do bigger deals. So you look into syndication, and you realize that the U.S. is where you could really do this. And you talked about the multifamily value add model was really attractive to you. It didn't work in Canada, and then of course it's very prominent in the U.S. So, and then you realize you could have this arbitrage to where you could bring these types of opportunities to the Canadian investors that you knew in Vancouver and the other areas. So great idea. You clearly had the background. You, like you said, you found some partners, and you start CPI Capital. So what happens next?
Yeah, so what happens next is in 2019. That's when we founded the company and started kind of the process. Early on, we had to understand that a real estate investment firm, particularly a real estate private equity firm, no matter what asset class they're focused on or what the business model is, it could be different asset classes under the commercial real estate umbrella. It could be multifamily, it could be industrial, it could be office, it could be hospitality. So it doesn't really matter what you could even be a portfolio of short-term rentals. But if you are managing an investment firm which deals with investors, you have these different divisions within the company. You have your acquisition department, which goes out there, finds the deals, makes the connections with brokers, has the underwriting skills to be able to analyze deals and underwrite deals. And then you have your asset management division, which after you've acquired the property, it executes the business plan. It does needed renovations, deals with third-party service providers or property managers, and so on. And then you have your investor relations, which is dealing with debt and equity. In most cases, investor relations deals with equity, basically going out there, creating leads, potential leads with investors, nurturing those leads, qualifying those leads, and hopefully when you do have a live deal, those investors will invest with you. So early on, we were wondering, how are we going to manage all of these divisions and build them from the ground up? And it wasn't like we had a huge exit and had made tens of millions of dollars and we could just come and throw cash at it and hire the top acquisition guy and pay him 150 to 200K a year just to sit there and try to find us deals and bring on an asset manager, again, same type of salary, and then have multiple team members for the investor relations. Now, the operations, there's a component there as well. You need a controller, a bookkeeper, somebody who manages the internal aspects of the company outside of those three divisions. So we didn't have the funding to be able to bring those individuals on. So early on, the three of us, us three partners, we became partners within the firm and shared within the profit, kind of a profit share model of the firm. But early on, the other issue was that we had never done a deal before in the U.S. So U.S. deals were very alien for Canadian investors. There was also a fact that they didn't really understand the private equity side of it, the syndication model where they're passive investors, they're limited partners. We are the general partner, so they don't really have any say in the deal. So there was a lot of education that needed to go and bring these investors on. So we made a decision early on that we had to partner with another group who had the track record, who had done deals in the past, and we could piggyback them to do our first couple of deals. And that's exactly what we did. We partnered with another group for our first few deals. The other difficulty was, and in that case, the asset management was nominal as well. We were just overseeing them, making sure they meet us on a monthly basis. We're hitting those metrics that we were hoping to hit. We see where the occupancy is at. If the occupancy is dropping, we'll have these discussions with them. But things went somewhat fine, but we learned a lot in that process. But the other aspect that was happening in parallel was about raising capital. How are we going to, and also keep in mind on these first couple of deals, it was also this lead sponsor, as is known in the space, who was also getting the debt as well. So we didn't have to sign on the debt and secure the debt. They had already secured the debt, so they were getting the bigger portion of the general partnership stake in the deal. So, but one aspect was the investors. How are we going to be able to raise money? So the first thing we did between the three partners is we say, hey, listen, let's contact and get in touch with our circle of influence. People who've done business with us in the past, people that basically know us, if it's friends, families, business associates. Let's get in touch with them and let them know what is this new business we've got into and if they'd be interested in investing with us. So that's exactly what what we did. And for myself, being a builder for close to a decade, almost 10 years, I reached out to a lot of my clients. These are people who were high net worth. They had trusted me with millions of dollars for construction costs and their projects. So I felt early on that converting those types of individuals was going to be a very easy process. But it didn't work the same way because the education was lacking. They knew me as a Vancouver builder. They knew me as somebody who was an expert in my space, building homes and what have you. When I brought them this private equity type of deal in Orlando, which was our first deal, which and it was a limited partnership structure where they were just limited partners and they were getting these units within this syndication. I had failed to take the first step is educating those investors about what it is that we do. So the conversion wasn't there as easy as I thought. Now, we did raise the capital we needed for that deal between us, the three partners, but we went on this pursuit that there needs to be an educational component in what we do. So we launched our podcast soon after, Real Estate Investing Demystified. We started writing newsletters, blogs online. We started becoming very active on social media, creating content. So not only there's a brand being built around the company, but there's a brand being built around each one of our executive team members. And as investors would come in to the funnel in some way, either through our past connections, either through a networking event, either through conventional marketing strategies like paid ads and SEOs, either through lead magnets on our website, there would be a nurture process. So that nurture process is that they get an email every Sunday at 6 a.m. Eastern. They get an email about a recap of what has happened in the past week in the economy, in real estate, and so on. We host monthly webinars, educational webinars. Again, so there's a nurture process that these investors, because at the end of the day, the proposition we're making, sure, we have a great deal. There's great economics for them. They're making above market returns, hopefully, if everything goes well. But they're signing an agreement, which is a 150-page document that says if we happen to lose all their money, they can't do anything about it. It's a big proposition to ask somebody to invest $50K. Our minimum is $50K USD. Our average check size today is $125,000 to $130,000. But that is a big proposition to ask someone who's seen you on social media. So that nurture process, that trust process is extremely important. And then our onboarding process as well. So if a lead comes in, initially, they go through a qualifying process to see, first of all, if they're accredited or not. If they're not accredited, they go down a different journey. If they're accredited, they go down a separate journey. And then our qualifying team members get on a call with them to qualify them. It's just answering them some brief questions. Are they accredited? Do they have liquidity? Have they ever invested as a limited partner in the past? Do they understand the asset classes that we're involved in, multifamily and BTR, which built to rent, which I'm happy to get into in a moment. After that, the investor gets on a call with what we call closer within our firm. So it's an executive team member who gets on a call with them, makes a personal connection with them, takes detailed notes in their discussion. So if the person says, my son is graduating, this year, that'll be in the notes. Next time they chat, they'll pull up the notes and discuss and see how their son is doing, if it's gone to college or not. So it's a very intimate process with investors. And then you hope those investors, you do well, you perform, and they're going to do referrals. But that's how really the company came about, and we built the different branches of the company.
Okay. All right. Appreciate all that. And a lot of questions there. So we talked about your background. You want to do bigger deals. You start this syndication company for deals in the U.S. And like you said, there's 3 different divisions, which all are, very intensive in terms of what's required to run them. You talked about the capital challenges early on, and there's just 3 of you. Right. Was there a point like early on, because it sounds like maybe you didn't really know exactly what you're getting into as far as like how much it was going to require, and you had to really kind of, I don't want to say you had to do more with less early on because of how much was required to make a company like this work?
Yeah, no, absolutely. I mean, that's an excellent question and excellent point. And our CEO, Eva Benesaki, says it the best. And she says that if you're looking to get into the space and you're not coming from an Ivy League school and you're not coming from a finance background and you haven't worked for a private equity firm, you have to be a bit illogical. You cannot go the logical route, because the logical route says that you need all of those prerequisites. You need to come from an Ivy League school. You need to have worked in finance for at least a decade. You need to have worked for a real estate private equity firm, and now you're branching out. So for us 3 partners, now one of our partners did have experience in real estate private equity, but us other 2, myself and my other partner Ava, we didn't. So there was this imposter syndrome early on, and that we felt so subpar to people we were having conversations with. In most cases, most of our investors were more educated than us, wealthier than us, because we could see when somebody has to get a third-party accreditation, we know how much they're worth. So it was definitely it seemed like an unattainable goal. But what really gave the wind under our wings was our performance. After we did a few deals and we were able to preserve our investor capital, even through a difficult time when there was a lot of distress in the market, because the first few deals we bought were in 2021 and 2022, which was the worst time to buy deals, we were able to still salvage our deals. So it gave us that a bit of confidence. And then there, we really ate, we ate, slept, lived real estate private equity. So all of us kind of really immersed ourselves in the space. So if it's on LinkedIn, all the connections that I have are mostly in real estate private equity. All the content that I absorb is real estate private equity. So I understand the market really well and the space really well. Eventually, I got a chance to be accepted into Harvard for their private equity and venture capital program. So I went there and spent a week on campus and was with 70 other great minds from all around the world that came and took that program. So one of my partners ended up authoring a book. My other partner ended up becoming a thought leader in the underwriting and analysis of multifamily. So we really grew through this process. When I look back the last 6.5, 7 years, it's been a difficult time. And early on, as you said, it was if we weren't a bit illogical, we should have never gone into this space.
Yeah, I love that because so many people can relate to that, having to be illogical and just sticking to it and not giving up before they really made something happen. And that's interesting too, because like you said, there's three of you partners. You're in this tough time and kind of facing what looks like something you shouldn't have even done on the surface, but yet you stuck to it, you gritted through it, and even the first couple of deals, it sounds like where you had to partner with another firm, there wasn't much profit in there for you, but you're preserving the investor capital, you're learning, you're making a name for the company. But through all that, was there ever a point in time where you thought about giving up?
Well, I was a successful builder. I have a very close relationship with my family, particularly my mom. So she wanted me to pursue that career. My other business partner, Ava Benesaki, was a top performing real estate agent for a decade with Remax. My other partner was a civil engineer building bridges. And all of our family knew what it is that we do, and we were living a pretty comfortable and successful life. So when we came to them and we said, hey, we're going to be doing this business. Most of the profits for the GPs are made on the back end as long as the deal performs, because we put the structure for GPs are to get some fees up front, nominal fees that just keeps the lights on, but their performance fees are in the back end, a portion of the upside, a portion of the profits. And our families didn't really understand that process. They understood that you put in the work and you get paid for it. So, and the fact that we were living our careers, and being a home builder and being a real estate agent and being an engineer, it's not a case where you can just shut down the business and then restart it anytime you wish. You've built those contacts, you have those crews, you have those relationships. So we basically, all three of us, we really burnt the bridges behind us when we started CPI, knowing that we were going to give it our all. And that was one of the bigger motivating factors, was the embarrassment of going back to our families with our heads down, saying that, hey, we failed. It was a fear of failure, but we also knew that this business, the upside and the potential was so great. So it wasn't just becoming the top agent in the city or becoming a builder in Vancouver. Real estate private equity, for example, Blackstone is one of the largest private equity. I think it is the largest private equity firm in the world. It's got over $1 trillion of assets under management. When they started out in the 80s, Blackstone was a leverage buyout shop. They would buy companies, make them perform better, and then they would exit them. They were a classic private equity shop. But at some point, they started having a larger allocation to real estate than they did to private equity. And same thing with a lot of other private equity firms, the Apollos of the world, and so on. So we knew that the ceiling was unlimited, where we can scale this company, where we can grow it. So we were very excited. And we knew that industry we're in is not an industry that technology is going to affect in any way. For example, technology could eliminate jobs or businesses in a very easy way. And we've seen that with AI today. But when it comes to somebody actually having a physical place to sleep in the U.S., which is a population over 340 million people, over one third of Americans are renters, and approximately between 10 and 15% of Americans actually live in apartment communities, some form of apartment communities. Now, townhomes also fall under that umbrella, and also built to rent falls under that umbrella as well. But so it was a big market, and that market was continuing to grow from post World War II. So America was becoming more and more of a nation. So we knew that the industry we were in has a really high or an invisible ceiling. We knew that it was an industry that technology couldn't change it, and the demand was going to continue to grow. And another aspect of it was market share. We also knew that when we looked at other industries, like for example AI, NVIDIA has, I believe, it's a 60% market share. When you look at smartphones, Apple has a 40% market share. When you look at banking, JP Morgan has a 17% market share. But when you look at multifamily and the largest market share, which is Greystar has a less than 0.5%, less than 0.25% market share in the multifamily space. So you know that it's a space that there is not one group that controls everything. It's very difficult to break in. Like imagine if we decided to build a smartphone tomorrow. Like it would be such a leviathan of a task. Whereas in a multifamily space, is a lot easier to enter space and grow, and we've seen that with us ourselves. So yeah, part of it was family, part of it was us believing in ourselves, part of it was learning on the job, but part of it was also really believing in the asset class and the business model that we were utilizing. One of the things I was struggling with is as a man, somewhat of a confident man, this idea of ever asking anybody for money was against my beliefs. You never ask for money from somebody. That's not a right thing to do. So I saw asking for investors to invest with us as me asking them for money, until I talked to one of my advisors when I was having difficulties, is that, hey, he told me that you're not asking for money. You're actually offering them something that alternative they wouldn't have access to. So he built that confidence in me that it wasn't as if I was asking for people to money and for them to give us money, but it was rather a partnership. And we were actually providing them with a service, which was them having access to these deals that alternative they couldn't have access to. So yeah, a lot there.
Wow. No, and on that last point, that's great self-awareness too, to realize that was like a block, and then having a mentor of yours going to help you reframe that so you could successfully get money from investors. And like you said, right, you're not just asking them for money, you're offering them an opportunity. Okay, so you survived these early challenges. All three of you are all in. You burnt the boats behind you. You're not giving up, right? Like you said, you all had success previously, so you certainly know what you're all capable. It sounds like the synergy of all three of you together really was a big factor in the company's success. So what was the inflection point where things really started to take off?
The inflection point was that the first two deals we did with one sponsor, things were okay. We learned lots on the job. Then we did another subsequent deal with another general partner, sponsor, as is known in the space. But at that point, we were like, hey, we're done being supplementary to another group. We need to do our own deals. So we went out there, and we were at the same time we were building our acquisitions and asset management divisions within the company as well, bringing team members and so on, creating standard operating procedures internally. So we went on the pursuit of getting our own deal under contract. So in June of 2024, there was a deal that came across our desk in the St. Petersburg submarket of Tampa Bay. We fell in love with the deal, 136 units, value add deal. We put it under contract, and we were able to be awarded the deal, raised close to $10.5 million, which in Canadian dollars, that's close to 15 million Canadian dollars. And we're able to take that deal down. So it was a huge monumental moment for the firm, because we were able to not only acquire our first deal, but do it as the lead sponsor to make all the decisions, sign on the loan. It was a Freddie Mac loan, so it was an agency loan. I remember that they did, because it's a government agency, they do background checks on all the team members for any lawsuits or any issues they've had. So I had some parking tickets in Vancouver when I was in my early 20s, and they even had a record of that when they sent an email seeing that information from a different country. So it was just mind-blowing of what we went through to get approved for an agency loan. But that was the biggest, I would say, moment for us, closing our first deal. And then from there, the other big milestone was when we had looked internally at CPI, realizing that our mandate and our vision initially was focusing on multifamily, but asking ourselves, do we want to limit ourselves just to multifamily value add, or is there any other business models that we want to utilize? As I mentioned earlier, my background was in home building myself. My other partner's background is a civil engineer. And we looked at this new asset class called build to rent, BTR, where it's basically an investment firm buys a piece of land, builds a community of single family homes or duplexes, stabilizes it, means gets it occupied to 90% or more, and then either refis or it sells it to an institution and exits that deal. So we saw the growth of BTR in the US, and we were very bullish on that asset class. And we were able to close on last year, we were able to close on a build to rent 30 duplex, 60 unit project in the Helotes market of San Antonio. So it was our entrance into a new asset class. It was our entrance into a new market. We were now in Florida and Texas. So that was another very big milestone with CPI, again, as the lead sponsor. So those were some major milestones.
Okay. All right. And again, it took 5 years from the inception of the company and you guys going all in and withstanding these early setbacks and just kind of flatline growth to you really closing a deal with your own funds without supplementary partner or kind of piggybacking on someone else. So yes. that had to feel good, right? After kind of gritting through all those tough times and really, like you said, closing a successful deal on your own.
Yeah, being our advocate, after 2019, when we founded the company, 2020, COVID hit. So real estate market completely stopped, completely shut down for a few months. And then the Fed had to, the central banks around the world had to print a lot of money to keep people from going to work. People had a lot of money in their bank accounts, so they started jumping online and doing shopping and buying a lot of stuff. And that resulted in massive inflation near extreme inflation in some cases. The inflation went up to 9.5% in the US. Central banks, particularly the Fed, has only one lever to pull if they want to battle inflation, and that's increasing rates. We were in a market when everything shut down for a few months. Then the rates were dropped. So the market went on a bull run, and us trying to get into the market was near impossible because other groups were coming in because of cheap debt. They were putting non-refundable deposits day one. People were asking prices that didn't make any sense. So it was very difficult to try to do deals as well in that time. But then after, when the Fed and central banks around the world realized that inflation is out of control, hyperinflation, that's the term I was looking for earlier, they had to start increasing rates. So they went on a tightening cycle and raised the Fed's funds rate 11 consecutive times. Commercial real estate loans are indexed off the treasury bonds. So if the Fed increases rates, that has a correlation to the treasury bonds, usually the 10-year treasury. And the treasuries went up from a couple of hundred basis points all the way up to 500 basis points. And it makes deals not pencil anymore, and didn't make deals make sense. Additionally, a lot of people had refinanced the properties they already had. So there wasn't a lot of deal volume because they already had to refinance to a better debt. They were cash flowing on those properties. So the motivation wasn't there for them to start selling deals. So the difficulty was COVID, what happened with the economy, what happened with central banks. It wasn't as if that the motivation wasn't there or the infrastructure wasn't there. It was the market was really a market from 2022 to 2024 when the Fed went on that tightening cycle. We somewhat sat on the sideline because it didn't make sense to do deals. So I just had to mentioned that it wasn't just 5 years of stagnation. It was 5 years of making smart decision of not getting involved in some deals as well.
Okay. All right. And one other question too. You mentioned the podcast and the newsletter early on, right? In terms of building trust and really nurturing those investor relationships. How important has that personal branding aspect been to the success of your company?
Yeah, I'll answer that in two ways. I mean, when it comes to investors and investor relations and that relationship you're building, it shows investors that you are there. There's a level of authority there, that you're out there, you're having a voice, you're interviewing expert guests, you're being interviewed by others. So you exist out there. So if they see your information somewhere, come into the funnel, they do a research on the executive team members, there's a lot of content online that showcases at least these guys must know what they're doing, right? I mean, even if they didn't, after spending 6 years of doing this every week, they must have learned something by now, right? So that was one aspect of when it comes to investors. So content, lead gen, proving that trust. But for us ourselves, the fact of having a weekly podcast, it also allows us to understand the real estate space much better. Over 6 years ago when I co-founded CPI, I thought I knew everything about real estate. I thought I knew it all. But when I started having our podcast and bringing different expert guests on that spoke about different ideas within the real estate space and finance and the economy, I realized how much I didn't know. So every week when we have a guest, we have to do an hour and a half research on our guests and prep for our show. Then the guest comes on. We do an hour interview of the guest. Then we take that material and send it to our team. So all of that is that concept of immersion within real estate. So it's not doing its job to create lead gen and the trust with our investors and creating other content. It's also the educational side for us and my co-host to be in the space. The other aspect of it is having a podcast, it opens a lot of doors. If there is somebody you want to get into a room with, there's a chance just to invite them on your podcast. You get it. It's like having them for an hour and you can ask any questions you want and get a crash course on whatever the expertise is, but also to break the ice with that potential individual, whoever it is, providing you potential services, potentially investing with you or other aspects. So it's been great. And lastly, I would say is that this is more of a selfish idea. People don't want to mess around with somebody who's got an audience, who's got a voice online, right? You don't want to rip that guy off or do something wrong to him because he can jump on his podcast and tell people what happened, what you did to him. So I take that as another thing that usually doesn't come up, but it gives you a bit of, it gives you a buffer of protection because people might not want to, take steps against you because they know that you're a voice of authority and you have an audience. So that's another way I look at it as well.
Love that. Okay. And August, looking back at the whole journey, right, from when you started as an entrepreneur, everything you went through, and then, of course, the CPI and the run you've had here, looking back on all this, what's been the best part of it for you?
Ooh, the best part of it is really growing myself as a businessman, as a man. Those two parts, understanding that a lot of unattainable goals that I never thought I could achieve, I've achieved them. It's been an incredible journey, partnering with my partners, making that decision to partner with them. I want to look back at it, and also building something that possibly my children, I have two sons. One of them is 14 months, so a 1-year-old and a 2-year-old pretty much. And I'm excited that CPI might be a company that they work for one day and they add value to this company and our investors and our tenants that live in our communities. So it could be a multi-generational situation as well, the same way I was looking at multi-generational people in Vancouver. It's been an incredible journey and learned lots along the way, and excited to continue this journey.
Okay. All right. And August, if people want to find you online, learn more about CPI or the potential opportunities you have, or just reach out for any other reason, what's the best way people can find you online?
Yeah, our website, cpicapital.com. It's a great place to go. You have lots of information there, a lot of great information you can download. We have our back of the envelope underwriting model that you can just download there. We have our educational webinars there you can access just through our website. And so lots of great content there. If you want to reach me directly, I'm very active on LinkedIn, August Biniaz. I'm the only August Biniaz on LinkedIn. So send me a message, say you see me on the show. I'd love to book a time and learn more about you and add value to you and your journey as well from what I've learned.
Okay. All right, August. We will link all that in the show notes for everyone. And thank you so much for being here and taking the time to share all this valuable wisdom from your journey with our listeners. We greatly appreciate it.
Thank you, and thank you for asking great questions.